Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down what is an RESP, how to invest in an RESP, and how to maximize this free government money to finance your children's education. I'll go over the benefits of the RESP, the rules and limits to follow, the government matching grants, and at the end, I'll talk about the best strategy to maximize your long-term growth. In part 2 of this series, I'll talk about how to withdraw from your RESP and what happens if your child decides not to go to school, so stay tuned for that. The RESP stands for the Registered Education Savings Plan, and it is one of the most important but underutilized tax-sheltered accounts in Canada, along with the TFSA and RRSP, which I've talked about in the past. This video is the 5th chapter in my Canadian tax guide, so I'll be assuming that you have a basic understanding of taxable income, tax brackets, marginal tax rates, and I'll be comparing the RESP to the TFSA and the RRSP. If you need a refresher on these tax basics, click the pop-up at the top right to check out all the videos in my Canadian Tax Guide playlist, and then come back to this video. The TFSA and RRSP are the two main tax-sheltered accounts in Canada that are available to all Canadians. But the RESP, the Registered Education Savings Plan, is designed to help fund post-secondary education, and it is only available to Canadians with children. Unfortunately, the majority of Canadian parents are not taking advantage of the RESP, and so they are missing out on thousands of dollars of free money for their children. I don't have any kids yet, but the day after my first child is born, I'm opening up an RESP, and I'll show you exactly how to get the most out of this tax-sheltered investment gift. Just like with the TFSA, the RESP's name is misleading. It's called the Registered Education Savings Plan, but it should not be used as a savings account. The RESP should be used as an investment account. Investing in an RESP gives you two main benefits: free money from the government and tax-sheltered growth. First, the government will match 20% of the contributions you make to an RESP, up to a certain limit, which I'll get to. These grants are free money from the government, and it guarantees at least a 20% return on your investment. That's amazing. The second benefit is that the RESP is tax sheltered, so any income you earn inside the RESP will not be taxed. So any dividends, interest, or capital gains you make will be tax-free, and so your investments will grow much faster inside an RESP than they would in a non-registered account. The tax-sheltered nature of the RESP is very similar to the TFSA. Your RESP is a large umbrella where you can hold stocks, bonds, ETFs, mutual funds, GICs, REITs, and cash. As long as these assets remain inside an RESP, you won't be paying any taxes on them. Stick around to the end of this video where I'll share my strategy on what kind of investments to hold to maximize this tax-free growth. Just like with the TFSA, your contributions are made with after-tax dollars, so you cannot use your RESP contributions to deduct your taxable income like you can with an RRSP. You might be thinking, why bother investing in an education fund? Well, consider this. The average cost of university in Canada, including tuition, living expenses, and textbooks, is between $10,000 and $20,000 every year per child. For a 4-year program, you're looking at $80,000. Where do you get this kind of money? Using an RESP, if you contribute $2,500 every year for 15 years to maximize the free government money, by the time your child is 18 years old and ready for college, you'll have over $85,000 saved up for your child. And more than half of that money didn't even come from you. It came from the government matching grants and the tax-free growth. That's the power of an RESP. I'll get into the details of this example later in the video. The RESP offers some amazing benefits for Canadian parents, but there are a few rules to follow. An RESP has to be opened on behalf of a child, which is the beneficiary. You can't open an RESP until your child is born and until your child has a social insurance number, or SIN. And just like the TFSA, there is a limited amount of contribution room. Otherwise, you can just keep putting your investments in and never pay any taxes. You are allowed to contribute a lifetime maximum of $50,000 for each child in an RESP. This $50,000 limit only applies to the money that you put in. It does not include the government grants or the income you make from the investments. And like a TFSA, if you exceed this $50,000 limit, you will pay a penalty of 1% every month on this excess amount. If you're not careful, this will cost you 12% every year. This is huge. So please keep track of all contributions you make, especially if multiple family members are contributing. There's no limit on how much money you can contribute each year. You could put in the full $50,000 limit on day one, but don't do that because it will limit the amount of free government money you get. Later in this video, I'll show you just how much to contribute each year to maximize this free government money. You don't have to start contributing right when your child is born, but you should start as soon as possible. And that's because the government will stop matching your contributions at the end of the year that your child turns 17. So you want to make sure that you maximize the free government money before your child's 17th birthday. Even though the grants end at 17, you can keep contributing to the RESP for the tax shelter growth until the 31st year since you opened the account. By 31, your child is probably done school, but if not, you're actually allowed to keep an RESP open for 36 years. So your child can decide to go to school in their mid-30s and still use that money that you invested. Let's talk about the fun stuff, the free government money. The money you contribute to an RESP will grow tax-free, but on top of that, the federal government will also add money to the RESP through the Canadian Education Students Grant, or CESG. This grant is an incentive for all parents and families to save money for their child's post-secondary education. No matter what your income is, even if you're a millionaire, the government will match 20% of your RESP contributions up to $500 per year per child. So if you contribute $1,000 to your child's RESP this year, the government will add an additional 20% or $200 for free. If you contribute $2,500 this year, you will gain the maximum amount of $500 in grants this year. The government won't match anything above $2,500. That's why you shouldn't contribute your entire $50,000 limit all at once. There is an exception to this. If you missed an RESP contribution one year, or you invested less than $2,500 in a previous year, that means that you have unused grant room, and you can carry forward this grant room and earn up to $1,000 in a given year. This allows you to catch up 1 year at a time. Here's an example. Every year, I contribute $2,500 to my child's RESP, and so every year, I gain $500 in government grants. But on my child's 5th birthday, I lost my job, and money was really tight that year, so I couldn't afford to contribute anything to the RESP that year. For that year, I have $500 of unused grants. The government won't match you if you don't put any money in. So now next year, I get a new job with a bigger salary, and now I can catch up for that missing year. So if I contribute twice as much, so $5,000 into the RESP, the government will give me the usual $500 grant, plus the $500 of unused grants from last year. In this way, I can make up for that missing year, but you can only make up for 1 year at a time. You can't contribute $10,000 to make up for 4 years all at once. There is a lifetime limit to the CESG grant money of $7,200 per child. That's $7,200 in free money from the government, available to every child in Canada, as long as you make the contributions to their education fund. The CESG grants are available to everyone, regardless of your income, but there are a few additional programs to help out lower income families. Everybody earns that extra 20% of grant money up to $500 per year. But if your household income is below $95,260, this maximum limit is increased by $50, so you can earn up to $550 a year in grants. And for lower incomes below $47,630 a year, you gain an extra $100 for a total of $600 in grants every year. This is important. This additional grant money for low-income families does not increase your lifetime total. Everyone can only receive a maximum of $7,200 in grants, but lower-income families can reach this maximum a little bit faster. Another program to help low-income families save for post-secondary education is the Canada Learning Bond, or CLB. With this program, your child can gain an additional $2,000 of free RESP money as long as your household income is below $47,000. If your family has more than 3 kids, this income threshold increases. There are also provincial education grant programs if you live in Quebec, Saskatchewan, or British Columbia. Please do your research and take advantage of these programs if you're eligible. Education is expensive, and every little bit helps. Also note that the Canada Learning Bond and the provincial incentives are completely separate from the CESG grants. So they will not affect the $7,200 lifetime grant limit or the $50,000 RESP contribution limit. For the rest of this video, I'm only going to be talking about the RESP benefits that are available to everyone, not just for lower income families. So for everyone, there is a lifetime maximum of $7,200 in grant money. But remember, the government will stop matching your contributions at the end of the year that your child turns 17. So you really want to maximize this free money as soon as possible. And here's how you do it. If you contribute $2,500 every year, you'll earn $500 of grant money every year. And do this for 14 years. At that point, you will have contributed $35,000 into your child's RESP, and the government will have given you $7,000 in grants. Now you only have $200 of grants left to claim. So in year 15, contribute $1,000 and you'll get that final $200 of grant money. At this point, you've maxed out the free government money. You've received $7,200 in government grants, and you yourself have contributed $36,000. Remember, you're allowed to contribute up to $50,000, so you still have $14,000 of contribution room remaining. But here's the thing. The RESP has two main benefits, the tax-sheltered investing and the free government money. You've now maxed out the free government money, so the only benefit left is the tax-sheltered growth. But you get this exact same benefit from your TFSA, and the TFSA is far more flexible. The money in the RESP should only be used to pay for university or other post-secondary education, but the TFSA has unlimited options. You can withdraw from the TFSA worry-free and spend it on whatever you like, including your child's education. So once you've maxed out the government grants of $7,200, I would suggest to put any remaining money into your TFSA instead. Of course, keep saving and investing for your child's education, but once the government grants run out, it's better to put that money in a TFSA instead of an RESP. You just have more options. If your TFSA is already maxed out, then of course, keep adding money to your RESP to take advantage of that tax sheltering. Why pay taxes on your investment income when you have tax sheltered room waiting for you? So if your TFSA is maxed out, then add as much money as you can to your RESP to fill up that remaining $14,000 of contribution room. There's no reason to limit yourself to an annual amount. We only limited those contributions to $2,500 a year to get those grants. Once the grants run out, you can contribute the remaining $14,000 all at once. The faster you contribute, the more time your investments will have to grow tax-free. Okay, so using the strategy, how much can we expect to make in our RESP? So each year we put in $2,500 and the government gives us an additional $500. And this is the fun part. We earn tax-free investment income on our money and the government's money. So $3,000 in total. We keep doing this and our investments keep compounding year after year for 14 years. In the 15th year, we only put in $1,000 and the government gives us the final $200 of grants. So in 15 years, we've put in $36,000 and the government has put in $7,200. Now we let this money grow for another 3 years until our child turns 18 and is ready for college. Let's assume an annual rate of return of 6%, which is pretty conservative for a stock and ETF portfolio. After these 18 years, our RESP will have almost $86,000 inside. We gained almost $43,000 of tax-free investment income for doing nothing, just for investing the money and sitting back. We gained a 20% return from the government grants themselves, plus a 100% return from the tax-free growth. We essentially doubled our money and the government's money in 18 years. This is the power of tax-sheltered investing accounts like the RESP. Of course, this is assuming that we stopped contributing after the grants run out. If we kept contributing to a TFSA or the RESP, this final number would be significantly higher. If you want to play around with these numbers, I've included a link to the Excel spreadsheet that I made in the description box below. I get this question all the time. What accounts should I be investing in first? Should I focus on my TFSA or my RRSP or my RESP? I'll be making a whole video on this topic, and I'll explore different paths you should take based on different scenarios. But for now, here's a quick answer. First off, you should pay down any credit card debt or high interest debt that you have. That'll give you peace of mind, it'll help your credit score, and you'll avoid those massive 20% interest rates working against you. That's effectively a guaranteed 20% return on your investment, and you can't beat that. Second, make sure you have an emergency fund. This is money that you can rely on to cover your expenses for a few months if you were to lose your job. This emergency fund is a shield to protect your investments. So if anything unexpected comes up, you have the money to cover it without being forced to sell your assets. This is incredibly important, and your emergency fund should not be tied up in investments. It should be available as cash when you need it, so keep it in a high interest savings account to earn a little bit of interest along the way. Right now, my favorite high interest savings account in Canada is the EQ Bank Savings Plus account. They offer 2% interest rates, one of the highest in Canada, and this isn't a promotional rate for a few months, this is 2% all the time. Plus, there are no everyday banking fees, no minimum balance required, free e-transfers, and free bill payments. If you'd like to get started with EQ Bank, click my referral link in the box below to sign up. There's no extra sign-up bonus for using my referral link, but if you do use it, I will receive a small referral bonus, so you'll be helping to support my channel. I've covered the importance of paying off credit card debt and starting an emergency fund in detail in one of my oldest videos, the 4 steps to become wealthy, so check that out as well. Once you finish these 2 steps, you're ready to start investing, and here's what I suggest. If you have children, your priority should be to invest in their RESPs before you start putting money in your TFSA or RRSP. Try to put in $2,500 every year for each child in their RESPs to take advantage of those government matching grants. Those grants alone are a guaranteed 20% return on your investment, and on top of that, you'll still get tax-free growth like you will in a TFSA. I know it can be hard, especially if you have multiple children, but try your best to put in $2,500 every year per child. After the RESP grants have been maxed out, then you should focus on your TFSA and RRSP. Choosing between those two is a huge discussion, and I'll make a whole video just on that. Once you've maxed out your TFSAs and RRSPs, then come back to the RESP and max out that $50,000 limit. You won't be getting any more grant money, but you should still take advantage of the tax-free growth. Once your TFSA, RRSP, and RESP are all maxed out, now you're finally out of tax-sheltered room, and it's time to start investing in a non-registered or margin account. Here, there are no limits, but you will be taxed on any income you make through dividends or capital gains. So we know how much money to put into an RESP, but what kind of investments should we actually hold inside? The tax shelter nature of the RESP is almost identical to the TFSA, and so we should invest in the RESP the same way we invest in the TFSA, with Canadian high-yield dividend stocks and ETFs. I went into detail on how to invest in your TFSA in my previous video, so click the pop-up at the top right to check that video out. Do not hold cash in a savings account in your RESP, at least not until you're ready to spend it. With a savings account, you're wasting that precious contribution room. Sure, you're avoiding tax on the interest, but a savings account will earn you at best 2% of interest, so you'd be saving a tiny amount of tax on this 2% of income. Instead, hold secure and established blue chip stocks and ETFs inside your RESP to gain much higher passive income through dividends, completely tax-free. And don't hold risky penny stocks in your RESP. Your children are relying on this money for their education. Plus, if your penny stocks crash, you will permanently lose this limited contribution room to your RESP. If you make a bad investment and you lose that money in your RESP, you can't put it back in. It's gone forever. Your children will need this money 18 years from now, so make sure you invest in companies that you know will still be around and still be successful. Also, if your stocks inside your RESP are currently down, don't sell them. Wait for them to bounce back. As soon as you sell them, those losses become realized, and now you've permanently lost that RESP room. And this is very important. The RESP is tax-free for Canadian dividends, but not for US dividends. If you hold US stocks or US ETFs, you will be charged a 15% US withholding tax on these dividends, even in an RESP or a TFSA. This 15% withholding tax is only waived in registered retirement accounts, like the RRSP, so this is where you should hold your US dividends. For your RESP, hold Canadian dividend stocks and ETFs. I've already made several videos on the best Canadian dividend stocks and dividend ETFs to hold in your TFSA or RESP, so make sure you check those out. You can open up an RESP account and start investing in stocks and ETFs using QUESTRADE, which is my favorite online broker. If you'd like to get started with QUESTRADE, click my referral link in the box below and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission-free. That saves you $50, plus I'll get a small referral bonus as well. So there you have it. That's the first half of everything you need to know about the RESP. The RESP gives you free money from the government and allows you to invest tax-free to finance your children's post-secondary education. You should contribute $2,500 to each child's RESP every year to maximize these government grants, and lower income families can earn even more. You should invest in the RESP just like a TFSA. Hold high-quality Canadian dividend stocks and ETFs to maximize the tax-free growth. Stay tuned for part 2, where I'll talk about how to actually withdraw money from an RESP, RESP family plans versus individual plans, and what to do if your child decides not to pursue post-secondary education. There's a lot to discuss. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel on YouTube, and hit that bell icon to be notified of my new videos every Thursday. And if you'd like to follow me on Instagram or Facebook at CanadianTShirt, click the link in the box below or click the links on my homepage. Be sure to tune into my next video on how to open a QUESTRADE account and how to transfer money into this account to start investing. Thanks everyone, and I'll see you guys on the next episode of The Canadian in a T-Shirt. Bye guys.